You start investing, adding a few dollars every day, waiting for something big to happen. But for years, it just crawls. Then suddenly, around the 100,000 mark, everything changes. Dividends grow faster, reinvestment accelerates, and the snowball effect becomes real. In this video, we'll look at the exact date that explains this tipping point, why growth seems to explode after it, and let's stir the pot a bit. Maybe it's not luck that makes people rich. Maybe it's patience disguised as math. Let's set the stage. We'll use a simple example. Investing $5 a day. That's about $1,825 per year. Every dollar you put in buys more shares, and each share earns a dividend. When you reinvest those dividends, they buy even more shares. That's the loop that creates compounding. Simple idea, right? But here's where it gets interesting. Early on, those dividends feel tiny, yet they're laying the foundation for what comes later. Think of it as planting seeds. The first ones barely sprout, but give them time and they start multiplying fast. Chapter 1. Why dividend compounding feels slow at first. In the beginning, compounding feels painfully slow. You add money, you wait, and the progress looks small. Let's say you invest $5 every day for a year. That's about $1,825 total. Depending on the yield, your dividends might be just $10 to $40. That's hardly noticeable, right? But here's the hidden power. Those small dividends buy extra shares. Those new shares start earning dividends too. That's how the snowball forms. It's quiet, steady, and almost invisible at first. Most people give up here because it feels like nothing's happening. But the ones who stay consistent eventually hit a point where the numbers take on a life of their own. That's the moment when time starts working harder than you do. The early stage is the grind, but it's also the setup for the explosion that comes later. Chapter 2. The math of the 100,000 tipping point. Now, let's break down why $100,000 feels like a turning point. Imagine your portfolio is worth $100,000 and pays a 4% dividend yield. That's about $4,000 a year, or roughly $333 every month. That's not just a number, that's serious reinvestment power. Every month, those dividends can buy multiple shares, not just fractions. And as those shares keep generating income, your returns start compounding on a much larger base. It's like climbing a hill and finally reaching the top where gravity flips. Now it pulls you forward. The same math that once felt slow suddenly accelerates. The key here isn't luck, it's scale. Once you cross that threshold, the machine begins to feed itself faster and faster. You're not pushing the snowball anymore, it's rolling downhill on its own. Chapter 3. Timeline and projections from the sample simulation. Let's look at what the actual numbers from the simulation show. We'll keep it simple. You invest $5 a day, reinvest every dividend, and hold a mix of dividend-paying stocks and ETFs. After the first year, your total contributions are around $1,825. Your portfolio value sits just over that mark, and dividends are still small, about $10. Nothing special yet, but fast forward to year 10, and the projection shows roughly $40,000. Your total contributions by then are around $18,000, so growth has already doubled your money. The 100,000 milestone appears around year 15. That's when the snowball starts to look unstoppable. By year 20, the projection hits about $250,000. Keep going to year 30, and the curve turns almost vertical, roughly $1.5 million in value with nearly $69,000 a year in dividends. Now, these are just modeled outcomes based on blended yields and growth rates, not promises. Real results will vary, but the shape of the curve, that sharp rise after 100,000, stays consistent. It's the visual proof of compounding in action. The early years are flat. Then suddenly, the line bends upward. That bend is the tipping point everyone talks about. The 100,000 mark isn't magic. It's just the place where math, time, and patience finally meet. Chapter 4: Real-world portfolio example and the metrics used. Now let's look at the kind of portfolio used in the simulation. It's made up of a balanced mix of dividend stocks and ETFs, each chosen for strong yields and steady growth. For example, SCHD showed about a 3.7% yield with a 10-year dividend growth rate near 11%. Then there's ABV with roughly a 3% yield and about 13% annual dividend growth. Lowe's came in lower on yield, around 1.8%, but its dividend growth averaged nearly 17% per year. Netties stood out with a 1.9% yield, but huge dividend growth, roughly 25% annually. Finally, Tractor Supply offered a 1.5% yield and more than 20% growth each year. When combined, these holdings created a blend of yield and growth that powered the simulated compounding curve. It's not about picking perfect stocks. It's about choosing a mix that balances immediate income and future growth. This kind of combination lets dividends grow faster, while reinvested shares keep adding weight to the snowball. Again, these are historical figures, not predictions. But they show why the right mix can turn small daily investments into something substantial over time. The lesson is simple: yield brings income, and dividend growth multiplies it. Chapter 5: Practical plan to reach 100,000 faster. So, how do you actually get there faster? First, increase your contribution if you can. Even bumping it from $5 a day to $10 cuts your timeline almost in half. Second, automate everything. Set up automatic deposits and enable dividend reinvestment. That way, the system keeps running even when you're not watching. Third, diversify. Don't chase the highest yield. Look for consistent companies with room to grow their dividends. That's where the real compounding hides. Also, stay patient. The market moves in cycles, and those dips you fear are often the best times to buy more. Remember, consistency beats timing. The goal isn't quick money, it's steady acceleration. Track your blended yield and dividend growth each year to see how your snowball is speeding up. The earlier you start, the longer you stay invested, the stronger the compounding effect becomes. Keep it simple, keep it automatic, and let time do most of the work. Chapter 6: Risks and Assumptions. Before we wrap this up, let's talk risk. Every investment carries it, even solid dividend payers. Companies can cut or freeze dividends. Markets fluctuate. Inflation, taxes, and interest rates all play a role in real returns. The data we're using here comes from historical averages and simulations, not guaranteed results. Actual performance will always vary. So, here's the clear disclaimer. This video is for informational purposes only. It's not financial advice, and I'm not recommending any specific stocks. Past performance does not predict future returns. Always research, and if needed, talk with a licensed financial professional before investing. The goal here is to understand the mechanics, not to promise specific outcomes. The key risks to remember are overconcentration in one sector, ignoring reinvestment discipline, and underestimating how market cycles can slow progress temporarily. Stay informed, stay balanced, and never invest money you can't afford to leave untouched for the long term. Knowledge and patience are your best protection. Let's bring it all together. First, compounding feels slow, but patience transforms it into power. Second, around $100,000, dividend income finally becomes big enough to feed on itself. And third, reinvestment and consistency are the true engines behind growth. That's the real tipping point. Not luck, not timing, just math meeting time. If you found this breakdown useful, check the video description for the sources and simulation notes. And tell me in the comments, when do you think compounding really starts to feel real? Let's see who's already crossed their own tipping point.